Hello everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 9. In this particular lecture, we will cover chapter number 2, unit number 3 of ICAI module, CA Final FR. Here, we will discuss the concepts, the basic provisions of Ind AS 7, and that is cash flow statement. And then in the later lecture, we will cover ICAI question answers, examples and illustrations. Okay, let's begin and study the basic concept of cash flow. What is it? It is basically tells that what is coming into the business in the form of cash or bank, okay, and what is going out of the pocket of the business is considered and evaluated in under cash flow statement. Okay, there are different heads, the presentation, and there are different criteria met up, when to describe, when to deduct, when to add. Okay, we'll discuss this in this lecture itself. Okay, but the important part is it includes both inflow as well as outflow. Okay, whatever is coming into the business or going out of the business, it considers both. Why it is being prepared? See, basically a company might be in profits but might have bad cash flow position. Okay, for example, you are making a sale worth rupees 1 crore but are able to encash only 5 lakh rupees. Okay, so your sales are great, you are profitable, despite it might be that your cash flow position is not good. Okay, not enough, cannot suffice, you have to take another loans and all, and whatever, you're not able to match up with your working capital requirements, etc. Okay, so basically management really needs to know what is its basically the cash flow position. Okay, so in order to know that, you have to prepare cash flow statement. Now as per Ind AS 7, as per Ind AS 1, as you know, a complete set of financial statement will be considered only and only when there is balance sheet, P&L, cash flow statement, change in statement of equity, and notes. Okay, so every entity has to prepare cash flow statement. Okay, there is no exemption at all. Every entity has to prepare. Okay, are you clear with this? Great. Let's see some important more points. Okay, it includes both cash flow, inflow and outflow. Okay, it excludes transactions that do not affect cash receipts or payments. For example, if you talk about, for example, you did a 1 crore sale. Okay, 1 crore sale, simple example. Okay, 60% is credit. Okay, that means they are debtors and you will be receiving some on a later date. Okay, whereas 40% is cash. Okay, so for cash flow purpose, you will consider this 40% and exclude this 60%. Okay, it excludes transactions that do not affect cash receipts or payments. Okay, that do not result into cash inflow or outflow. This is excluded. What does cash over here means? Cash always means the currency cash as well as the deposits that have been put in bank. Okay, but these must be flexible. It should not be fixed deposit. FD means fixed deposit. So fixed deposit is never considered under cash and cash equivalent. Fixed deposits are never considered as, it should be flexible, that whenever you want, whenever you demand, you can withdraw such amount. Whenever you want, you can deposit the same. Okay. Known amount of cash. This means that the cash amount that will be received on redemption should be known at the time of initial investment. For example, if you are doing FD or anything, okay, and you know that if I am doing this FD of 5% and for next 10 years I will be getting this particular return. Okay, if you know that return, then this is known as known amount of cash. You know that if I am putting in, for example, 1 lakh rupees as deposit, at the end of the maturity you will be receiving 1,50,000. So if you know the known amount of cash is this 1,50,000. Okay, example. Now next, cash and cash equivalents. This is a very big term. Okay, as you know, normally there is operating activity. There are 3 activities. Okay, operating, financing and investing, and later this all cash flow is adjusted with the opening figure, and then finally comes a closing figure. Okay, we will see the format, don't worry about that. Okay, but now right now what I am trying to say is cash and cash equivalent is a broader term. It includes cash, it includes bank, it includes demand deposits. Okay, but it is a broader term. cash and cash equivalent is a broader term. How come? Because it also includes those marketable securities which can be encashed in 3 months, okay, or you can say 90-day period. Anything that is short term and can be encashed in next 3 months, then this is known as cash and cash equivalents, okay. These are considered as equivalent to cash because these can be encashed quickly whenever you need, okay, within 90 days. So the duration criteria is 90 days or you can say 3 months. Please read this. Short term highly liquid investments, highly liquid means can be encashed, be easily convertible into cash. This includes all investments up to 90 days. A long term investment for which remaining maturity on balance sheet date is 3 months or less is treated as cash equivalent, okay. For example, you have made you have made some investment which is of 15 months, okay, or 18 months, any. But now when you are preparing the cash flow statement, okay, annual cash flow statement, what the period from the end of the period that you are preparing, for example, you are preparing balance sheet for 31st March 2022, okay. Now from this date, if it is encashable in next 90 days, okay, the remaining due period is less than or equal to 90 days, then this can be considered as cash and cash equivalents, okay. So please keep in mind, cash and cash equivalent is a broader term, okay. Next, when it comes about bank overdraft, it is a very questionable and confusing point, okay. What is it? It is generally every time financing activity. What is bank overdraft? It is withdrawing over and above what you are having it, okay. For example, if you have 1 lakh rupees, but bank gives you a facility to withdraw amount from the bank over and above 1 lakh rupees, okay. This is known as bank overdraft. So bank overdraft is generally a financing activity. What is financing activity? The source from which you are bringing in the money for operating the business. This is known as financing activity. For example, you issue shares, okay, you are raising money, you are raising funds. This raising funds and repayment of funds is known as financing activity, okay. Now the bank overdrafts are in general criteria financing activity always, but only and only if it will be considered as operating, when and only when the bank overdraft is integral part of cash management. Bank balance often fluctuates from being positive to overdrawn, then classified as cash and cash equivalents, okay. A business entity has a nature that it has to keep a bank overdraft, and it usually refills that bank overdraft and makes it to positive balance, and then at times there are times when the entity withdraws and makes it a negative balance, okay. So it is a regular process of the entity. It is an integral part that at times the bank overdraft becomes positive and negative, okay. When there is surplus, it is then again repaid to the bank and the bank overdraft is declined. If such is the nature, okay, if the fluctuating balances of bank overdraft is there, continuously and regularly, repeatedly there are positive and negative balances, then an entity can classify this as operating. Other than that, if you keep a bank overdraft for a long term and it's continued as a negative balance for a long period, it acts like a financing operation, okay, and hence it is termed or classified under financing activity. Are you clear with this? Generally financing activity, but fluctuating positive and negative balance are done repeatedly by the bank. It is integral part, if then it can be considered as operating. Equity investment has been excluded from cash and cash equivalent unless they are in substance cash equivalent, okay. These are excluded from cash and cash equivalents unless they are in substance are cash equivalent, okay. These will be removed. Equity investments are generally not cash and cash equivalents, okay. An investment normally qualifies as cash and cash equivalents only it has short term maturity up to 3 months or 90 days from the date of acquisition, but a long investment which has upcoming maturity of 3 months remaining, then such remaining balance of 3 months or lesser can be considered as short term. Okay, even though it is a long term, but if it has remaining balance as lesser than or equal to 3 months or 90 days, then this can be considered as cash and cash equivalents. Okay, see, there is a very good example in the we will discuss in the next lecture. Please don't skip that. Okay, this 3-month criteria will be cleared in that example. Okay, FDs are never considered as cash and cash equivalent. Equity investments are never considered as cash and cash equivalents. Okay, now what is cash management? Cash flow excludes movements between items that constitutes cash and cash equivalents. Cash and cash CCE, I will term it as CCE, cash and cash equivalent. So it has, for example, cash, bank, okay, I can say short term investments, etc. Okay, it has multiple things, content, okay, it has multiple components. So at times it might be that you are withdrawing cash of rupees 10,000. So what happens? It is deducted from bank and added to cash balance. Okay, it can be that you are investing in short-term investment. So it is added to short-term investment and deducted from bank. Okay, this is an example. So there are at times transactions that are held within the CCE component. There are at times transactions which are within the CCE component, that is cash and cash equivalent. So such transactions are termed as cash management. Read it once. Cash flow exclude movements between items that constitute cash and cash equivalents because these components are part of cash management of an entity. Okay, rather than part of its operating, investing or financing, but it will be included in CCE itself. Cash management includes investment of excess cash in surplus equivalents, like I told, short-term investments and all. Okay. Now next, there are 3 activities. First, operating, second, financing, and third, investing. Okay. Operating is the major source of revenue, okay, from which the business is earning its major source of revenue. This is termed as operating. Financing, the source from which you are arranging funds, is known as financing. Okay, and investing, like for example, there can be investments like plant, property, equipments, or any other investments like mutual funds, equity shares, and etc. Okay, so these are investing, where you are parking your surplus fund. Maybe in order to run the business or to make it more profitable. Okay, how cash is generated by entity during the particular reporting period, how it is applied. Okay, it tells you in total that how it is generated, this is financing activity, and how it is applied, how it is invested. Okay, while doing so, it takes into consideration the opening balances of the cash, then adds the cash generated, that has been generated within the entity, removes or deducts the cash flow that has been made via payments and all. Okay, and then reconciles it with the closing balance. It should always match with the closing balance, opening balance, plus these add and less adjustments that have come in or that have gone out of the business. Okay, after making this adjustment, opening plus adjustments should always be equal to closing. Okay. Next, objective of cash flow information. First, to provide information about historical changes in cash and cash equivalents. What have been the changes since last year or last to last year? Okay, it tells you the change or historical changes. Okay, history of changes. To assess the ability to generate cash and cash equivalents. Okay, to analyze the capacity of any business, that what is its cash generating capacity. Next, to understand the timing and certainty of the cash generation, that is trend and probability. What is the surety that particular company will generate cash? Okay, these are the 3 information that one gets from the cash flow statement. The standard requires all entities to present cash flow statement, as I told, Ind AS 1 mandates it. Cash flow from operating means the principal revenue producing activity, that is core activity that generates the major source of revenue. Hence, the primarily related to P&L and all. Okay. Next, benefits of cash flow statement. Firstly, provides information enabling evaluation of changes in the net asset and financial structure, liquidity and solvency. It tells you how solvent, how liquid is the current cash position of an entity. Okay, for example, I told you, if you are doing a sales of 1 crore rupees, okay, it is a very great sales amount, okay, and you are profitable. But might be, on the other hand, your cash flow position is very weak. You are not able to encash it on time, within time. There is surplus need of working capital. Okay, every time you need to source it out. Okay, you need to take it from other businesses or from banks and all. Okay, so this tells you the current cash position of the entity. Okay, assess the ability of the to manage cash. It tells the stakeholders that get an idea about what the source of generation is and what the source of investments are. Assess and compare the present value of future cash flows. Helps the company to predict about future cash flows. If it knows, for example, in the past year it had a cash flow of rupees, for example, 10 lakhs. Today, this year, it is about 10 lakh or you can say 12 lakh. So it can predict in future, for example, an estimation that in particular next 5 years or 10 years, what will be its estimated revenue in cash, what will be its cash flow position. And this is very much helpful while you do the due diligence, when you are purchasing or acquiring any other entity. You really need to know that. The owner or who is making the deal really needs to know that what is the cash flow that it will be generating, how much profitable it will be. Okay, so will it cover my cost in next 1 year or 10 years or 100 years. Okay, the owner is really excited or interested in knowing all this. So cash flow statement somehow solves this all and tells you and lets you compare the cash flow position of current and the previous period, as well as the future predictions can be done based on this. Compares the efficiency of different entities, since all the entities will be providing their cash flow statements. Okay, and similar nature entity, for example, you are producing steel, okay, and the nearby entity is also producing steel. If you are on the same level, you can see that it is generating higher cash flow and you are not, then you can take steps that how to generate and encash more frequently. Okay, this can be done. Okay, this lets you compare the efficiency of how different entities are in the context of cash generation. Inflow and outflow, these are some examples given. Inflow is whatever cash or bank balance is coming into the entity is known as inflow, and whatever is going out of the entity's pocket is known as outflow. Okay, for example, from sale of goods you will receive something, from sale of service you will receive something. The goods and services will go out. In context of that, you will be receiving some cash or bank. Okay, receipt from royalties, okay, any other incomes and all. Receipt from insurance entity, receipt for insurance entity. If you are an insurance company, okay, you are receiving the premiums every year, every month and all. Okay, so these receipts are inflow for your company. Cash, whereas on the other hand, since we are business of producing steel, okay, then we are paying some insurance premium. This is expense for us, that is expense or you can say outflow for our entity. Similarly, cash receipt on account of contract held for trading. Okay, now payment to supplier, any payments made for goods and services, payment to or on behalf of any employee. Okay, cash in payment of general business expenses, payment of taxes and all relating to investing and financing, except. Okay, now very important thing comes is, if tax is very general, in general the tax is always considered in P&L portion, that is operating cash flow. Okay, but if it is directly related to some particular transaction that is of the nature of, for example, financing, then such tax portion will also be considered under financing activity. For example, you have issued shares and received money, this is financing activity. Okay, now you are paying dividend on these shares. Okay, so this is also financing activity outflow, no doubt. But on this dividend, since you are an entity and paying dividend, you have to pay dividend distribution tax, that is DDT, along with the dividend. Such tax is since directly related to the dividend and such is directly related to the financing activity. Such DDT amount, dividend distribution amount, will also be considered as an outflow of financing activity. Okay. Next, this is very important. Why so? Because the question of ICI question is there. Okay. And other than this, it is a very important concept. Now what happens is, recourse factoring. Entity retains all the risk and reward substantially, only outsources and directs the work. Okay. What is factoring? For example, you have debtors of rupees, for example, 10 crores. Okay. And now you want to focus on your core activity. You do not want to follow up with these debtors, but you want to collect it. Okay. You want that collection faster as well. Okay. You want to remove or decline the chances of non-payment, bad debts. Okay. Then what you do, you outsource this work to a factoring agency, that is any institution that says that okay, I will recollect from your debtors, don't worry, I will encash all your debtors. So what you do, you simply give your debtors list, that particular entity will encash it for you, bring cash in return for the debtors. Okay. Now what happens is, this can be done in two ways. Either you as an entity can hold all the risk and reward, all the bad debts and all the surplus collected is your responsibility. Okay. So this pattern is known as recourse factoring. Whereas if you transfer all the risk and rewards, whether that factoring agency collects surplus or collects less amount, it is all its own headache. Okay. You as an entity are not bearing any sort of risk and reward. You have transferred these all. If such is an setup, then this is known as non-recourse. Okay. See, simply if entity retains and keeps all the risk and reward with its substantially all of the risk and reward of the factored receivables. Okay. Cash received is classified as financing cash flow. Now what happens? For example, simply there is a 10 crore debtors. There is a 10 crore debtors, for example. Okay. Now what you did, you said to a factoring agency, okay, you said factor that, oh factor, please give me right now 9 crore rupees, please give me. So this factor pays cash of rupees 9 crore, okay, and takes away all your debtors of rupees 10 crore. So this is 1 crore fees of the factor, for example, its own commission for giving you the service of collecting the debtors. Okay. Now if you say that all the shortfall that shortfall that the factor will receive from this 9 crore rupees, for example, the factor receives only 7 crore rupees. So if the 2 crore rupees is the liability or the loss of this factor, or if the factor receives 9.5 crore rupees or whole 10 crore rupees, the surplus is the responsibility of the factor itself, then this is non-recourse. If it is the responsibility of the entity, it is retaining all the risk and rewards, then it is recourse. Okay. Now what happens if we talk about this recourse factoring, where all the risk and rewards are retained by the entity? What it does, since it has a balance sheet, see, please see this, it has a balance sheet. This is asset side, this is liability side. Here debtors are returned, okay, for example of rupees 10 crore. Okay, 10 crore rupees debtors are there. Now since immediate cash has been given by the factor, but it is still retaining all the risk and reward, that's why the control has not been transferred. Since control has not been transferred, all the risk and rewards are being held by the entity itself. It cannot de-recognize such debtors. It cannot de-recognize or remove it from the balance sheet. Instead, what it will do is, it will add cash of rupees 9 crore, okay, and create a financial liability of rupees 9 crore over here. Okay. And on the final settlement of like whatever it has received, if it has received surplus or less, it will adjust that and then remove debtors when finally all the control and risk and rewards are not happening, okay, has been covered up, no risk and reward is pending. In such case, only such de-recognition will be done. Okay, are you clear? And such financial liability will be removed. So there are two entries in case of recourse factoring. See, Entity retains substantially all the risk and rewards. Okay. Such cash received is the immediate cash received from the factor is classified as financing cash flow. Thereafter, when factor receives cash from debtors, then it is non-cash transaction. Then this is non-cash transaction. Okay. And both liability, that means when on the second step, when all things are covered up, the financial liability and debtors are cancelled, are removed from the balance sheet, are de-recognized. Okay. On initial cash flow, receipt, on initial cash flow receipt, you will not de-recognize the debtors from the balance sheet. Are you clear? In case of non-recourse, since all the risk and rewards are transferred, the control has been transferred, simply the debtors will be removed from the balance sheet and the cash will be taken in the balance sheet. Okay. Does not retain any risk and rewards. Cash receivable is operating cash flow. Entity has received cash in exchange for receivables. Okay, simple. Next comes direct method and indirect method. These are two different methods that are used for preparing cash flow statement. Okay. Under direct method, what happens is you add all the cash revenues, cash incomes, and from that you deduct the cash payments. Okay, cash expenses. After that, what net you get is your operating income, operating activity cash flow. Okay, are you clear? Whereas under indirect method, what you do is you start with the P&L balance, that is net profit. Now you remove such non-operating incomes, non-operating expenses. Okay, you remove the non-cash incomes, non-cash expenses, and then you adjust the working capital, and that's how you get the cash flow under operating activity from indirect method. Okay, so here you are starting directly with the incomes, adding incomes and deducting expenses. All should be in cash format, whereas here you are starting with P&L, that is indirect method. You are starting with P&L, and what you are doing, you are deducting the non-cash, non-operating income expenses and adjusting the working capital. Okay, the trick point is over here is that the operating cash flow amount will be same from direct method and indirect method. Okay, the cash profits will be adjusted from cash flow arising from investing and financing. If yes, if non-operating cash will be removed. The payments to supplier and receipts from customers are also considered. Non-cash expenses and all, since not already included, you will not be excluding them. Okay, you will simply be ignoring all the non-cash income and expenses. Since in the indirect method they are already included in the net profit, you will be removing it from the operating activity cash flow. Now TOP, this is top down approach. This is top down approach, that is incomes minus expenses and then cash flow. Whereas here this is bottom up. Why bottom up? You are starting with the net profit and then you are heading towards operating. You are removing the extra things that have already been recorded, which should not have been recorded for calculating cash flow under operating activity. Okay, this should be necessarily same. The operating activity cash flow should be same under direct and indirect method, both. Now foreign currency cash flow. All cash flow in foreign currency shall be recorded using a rate at date of cash flow. Okay, very important, keep in mind, from the date at which the cash flow is actually coming in or going out. Exchange gain loss, if unrealized, if it has not been yet realized, are non-cash and should be removed. Okay, for example, on 31st March, okay, you are translating the currency, okay, into Indian currency, and there arises some foreign currency conversion loss, okay, for example, of rupees 10,000. Since it has not been yet realized, since you have not made the actual outflow of such payment, then this should be removed from the P&L portion. Okay, simple, non-cash. Tax income, I've told about this. If it is generally operating activity, okay, but if it is directly related to investing or financing, then these will be treated as financing and investing respectively. All taxes are classified as operating except when they are related to investing or financing. For example, TDS on interest income. For example, capital gain. On investment, you earn capital gain on which you have to pay income tax. So, such capital gain tax will be included under which head? Investing activity. Okay. Next, there are some examples given. Suppose the money is received on account of exports on 15th January, okay, 2001 of US dollar. The company prepares the accounts in rupees. In such case, the exchange rate between USD and rupees on 15th January, on which the actual inflow or outflow is happening, okay, on which the actual transaction money is received, you will take the exchange rate of that particular day. Rate at the date of cash flow. Next, another example. Suppose entity A, Indian company, purchased goods for resale from France during January for euro 10,000. Exchange rate 1 euro equals to rupees 70 on a credit period of 4 months. It accounted for the purchase of inventory of rupees 7 lakh. On 31st March, the exchange rate was changed to 1 euro equals to rupees 65. It has purchased inventory. Now this means you have to make an outflow. You have to make an outflow. Okay, such payment was when transacted was 7 lakh rupees. Now since euros has been changed, the transaction exchange currency has been changed. Now you have to only pay 65 per euro. Okay, this means the liability have been declined. This would mean an unrealized gain due to exchange fluctuation of rupees 50,000. Since payable will be recorded at rupees 650 at closing exchange rate, assume that the inventory is unsold at the date the movement is reported as under. See, what you do is, since inventory is coming in, it will include working capital changes. Firstly, the profit is rupees 50,000. Why profit is rupees 50,000? Because 7 lakh minus 6.5 lakh, which you had to pay, but now you will have to pay only 6.5 lakh. This is like foreign currency exchange gain. This is foreign currency exchange, okay, exchange gain, okay, or conversion gain, whatever. So this is 50,000, 7 lakh minus 6.5 lakh, okay, 7 lakh minus 6.5 lakh. Now there has been increase in inventory. How do you calculate this? See, for example, there is a balance sheet. There is a balance sheet. This is asset and this is liability. Okay, assume that this asset balance sheet is freeze. Okay, you cannot move any thing. Okay, and only the movement can be done in cash. Okay, so for example, the inventory, this needs to be balanced out. Liability and asset should be equal. If inventory has increased, okay, in order to make this equal, what you need to do? You need to decrease cash. That's why minus 7 lakh. Increase in payables. For example, if you have payables increase, that is liability have been increased. In order to keep it match, what you need to do? You need to increase cash. Okay, that's why 6,50,000 has been increased. Net cash flow is from operating activity is 0. Okay, this is an example just to show you how the working capital adjustment is done and how foreign currency exchange transactions are recorded. This is very, very important for the exam purpose as well and for your practical balance sheet purpose as well. Okay, in case of doubt, please let me know. Now there are some specific treatments. See, simply profit and loss on sale of asset. This is simply never an operating part. Okay, it is always investing part. Okay, it is always investing activity. But if your profit therefore it should be removed from profit and loss and it should be transferred, adjusted to P&L, and it should be taken to investing activity. Property built for let out. Generally, it is always investing activity. Okay, you have invested in some building and you are receiving some rent. This is both investing activity. But this is your business. If this is your business, building the business is your business, construction of building is your business, then this will be operating activity. Okay. Next, interest income and expenses for financing enterprises. Normally, basically in general, the interest income and expenses are operating. Okay, but if we talk about our interest income and expenses are generally financing activities and investing activities. But if you are a bank, a financial institution, and your core business is of lending money and receiving money, depositing money and providing interest and receiving interest, if this is your core business, if you are a bank or financial institution, then such interest, income and expenses will be your operating activity. Okay, so it all depends upon the basic principal revenue from which source you are earning. What is your principal business activity? Next, interest and dividend, generally what? Investing and financing activity. But if it's your regular business, then it is your operating activity. Method of presentation, as we told, cash flow operating activities can be presented either using direct or indirect method under IAS 7, that is International Accounting Standard 7. Okay. Now this is a simple representation of how it is prepared, the format. Simply I told you direct method, you have to add all the cash incomes, all the cash revenues, all the cash receipts, and then minus or deduct all the cash expenses, cash losses, okay, any payments that you have made. Finally, you will get a cash flow before tax, cash paid, and that's how you get operating cash flow. Whereas if we talk about indirect method, you start with P&L. You always start with P&L. You adjust non-cash income and expenses. You adjust non-operating income and expenses. You adjust working capital, and that's how you reach the cash after tax. Okay, operating cash after tax. Now what happens is, here you for working capital adjustment, I told you assume that balance sheet, okay, asset and liability. For example, it is freeze. Always try to match it and consider only cash can move. Okay, so for example, if we talk about increase in current asset, okay, for example, current asset increase, then what you can do? Cash will be correspondingly decrease. For example, increase in current liability, so current liability increase, cash will also increase. Okay, if we talk about decrease in current liability decrease, to match it you have to decrease cash. Okay, this is how cash flow working capital adjustments will be done. Now investment activity, investment means you are sacrificing some current portion and investing it, parking it at some other thing or asset, or you can say at any good or service on which you are very much sure that you will be receiving a better return than today. Okay, it will help you in growing the business. Then this is known as investing activity. You receive interest, dividend, etc. in return. Entities need some amount of investment for their future survival. Okay. Accordingly, Ind AS 7 prescribes that all cash flow on asset and investing except those which have been classified as part of working capital. Okay. Instead, only the liquid asset and liabilities, only the current asset and liabilities are not considered as investment. Other than that, all the assets investment are considered under investing activity. Whether sale or whether purchase, everything, whether outflow or inflow, it will be considered under investing activity if it is related to particular asset. Okay, it does not include current asset. There are some examples given, you can read these. Okay, for example, receipt of sale of any PPE. You are selling out any property and you are receiving some cash. This is inflow from investing activity. If you talk about cash, you have to pay any capital gain tax because of that. So that is your investing activity cash outflow. Okay. Financing activity, as you know, during the life of an entity, money is needed. You will raise funds from outside. It can be from shareholders, it can be debentures, deposits, any form, loans. Okay. Now these are known as financing activity. Even repayment of the same is also considered as financing activity. You might have to pay interest and dividend on the same. For need of money, funds are raised and repaid as per the agreement. Okay, so as and when they are raised or received or paid, these are deducted and added to the financing activity. All such flows are classified as financing activity. All such flows means both inflow and outflow. Next examples are given. For example, cash proceeds from shares issue, okay, or from equity instrument. You issued shares and that's how you raised money. Your entity received money from the shareholders. So this is financing activity example. Inflow, you are repaying them or dividend or paying dividend on the same, then this is known as outflow from financing activity. Okay, same. Even the loans, these are very important. Short term loans, long term loans, all are considered as financing activity. Okay, if they are paid, then this is outflow. Reconciliation means all cash flows are classified as a reconciliation item for which cash management decision is still pending. For which cash management decisions are still pending, this will be considered as reconciliation. Such items are called as CCE. This means, I told you that these are broader terms. CCE, cash and cash equivalent, is a broader term. It includes cash, bank balance, and the securities that are invested and can be encashed at any time. Okay, even cash management, we have heard a term, any inter transaction within the CCE transaction, intra transaction. For example, you withdrew 10,000 cash from bank, so bank will be deducted and cash will be added. Okay, but these both are the components of CCE itself. Reporting cash flow on net basis, so this is generally not allowed. For example, you are selling a particular plant of rupees 10 lakh and buying another plant of rupees 9 lakh. So it should not be like you cannot do this net. You have to make an outflow and you have to make an inflow separately of these 10 lakh and 9 lakh. Okay, you do not need to make it on net. Okay, all cash flows are presented on gross basis, no net is allowed. Net reporting is required only when it can be contractually or legally permitted as per the agreement, as per the law. Okay, changes of ownership, this is very important. Okay, now we have to see that when you are investing in equity shares of some other entity, either you are gaining any control or not, either you are losing any control or not, either there is change in ownership or not. If change in ownership is there, that is control has been lost or you have gained control. If change in ownership is there, okay, then this is termed as investing activity. If you have obtained control, then investing activity, lost, then investing activity. But if you have invested, for example, another 5% and this is not making any change in your ownership, in your control power, then this will be termed as financing activity. Okay, so very important, you have to see that whether control has changed, control has not changed, control not changed. Okay, if control changed, then investing activity. Okay, and if control not changed, then financing activity. Okay, let's see some examples are given. For example, the existing position is 80%. Currently, you are holding 80% of the equity shares of that particular entity. Now, you have deducted, you have sold out 50%. Okay, sold out 50%. So now it equals to 30%. So before you were the majority shareholder, now you were the holding company, but now since 30% is only left, you are no more holding company. The ownership, the control has lost. Since control has been lost, if there is change in ownership, therefore it will be investing activity. For example, you were having earlier 10% and now you purchased 80% more. Now it equals to 90% current. Okay, this is current position. So now it equals to 90%. Earlier you were holding only 10%, now you gained 90%, and that's how you have become the majority holding of that. Ownership change, investing activity. For example, you were having 100% of the equity share holding and you sold out 80%. This results into you sold out 20%. This results into 80%. So this 80% will be considered as financing because 100% also you were the holding and in 80% also you are the holding. There is no change in the ownership. Control, no change in the control, no gain of the control ownership or no loss of the ownership, therefore it will be financing. For example, you were having 70% earlier, currently you added 10% more, that's how you become 80% again. Okay, so does it make any difference in 70 and 80%? You were holding previously and holding again after 10%, even your current position is 80%. So ownership change is not there, control change is not there. Since control has not changed, then you will be classifying it as financing activity. Okay. Lastly, there is a carve. Carve out means something that has been removed from Ind AS which is already in IAS. Okay, and the numbering is same for IAS and Ind AS. For IFRS, the numbering is 100 plus. Okay, so in IAS 7, that is International Accounting Standard 7, gives an option to classify the interest paid and interest and dividends received as item under operating cash flow. Okay, Ind AS 7 does not provide that such option and requires these items to be classified as financing and investing activity respectively. Okay, now what happens is IAS 7 does not provide any other option. Okay, gives an option to classify as operating, financing or investing activity. Okay, now IAS 7, that is Foreign International Accounting Standard. Okay, the foreign series, that is IAS, International Accounting Standard. Ind AS 7 says that, okay, IAS gives an option to classify, provides an option. Okay, option given. Whereas Ind AS 7, okay, that is Indian Accounting Standard, does not provide such option, no option. Similarly, why? Because, see, Ind AS 7 does not provide such an option and requires these items to be classified as item of financing and investing activities respectively. If such interest and dividend is there, there is no option to classify it as operating. If it is related to financing, it will be classified as financing. If it is related to some investing, then it will be classified as investing. Such interest and dividend is no more, will be included as operating activity. Okay, IAS 7 gives an option to classify dividend as item under operating activity. Dividend can be classified as operating as per IAS, but Ind AS 7 requires it to be classified as financing activity. If you are paying such dividend, if you are paying any sort of dividend, it will always be classified as financing activity under Ind AS 7. Okay, are you clear? This is carve out because the option was available in IAS 7 but has been removed from Ind AS 7, and that's how it is carved out. See, the IFRS, IAS and Ind AS all are same. There are only the carves or the differences that are that makes Ind AS and IFRS different. Okay, if you study Ind AS and study the carves, you are studying the Ind AS itself. Okay, you are studying you are also covering the IFRS. Even you can compete any sort of exam. It can be ACCA or ICAI post qualification for the members. You can fight them any. Okay, one exam is there. You can get diploma in IFRS. You can get certification from ICAI. I hope it is clear. In case of any doubt, please reach out to me. See you in the next lecture. Till then, take care, be safe, stay tuned.